Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from across the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blaire, and joining me today on the floor of the New York Stock Exchange for our market briefing and also to weigh in on the top stories of the day is Tai Wong, independent proprietary trader. Tai, happy Friday, and thank you for joining me.
Oh, great to be here. It's a beautiful day. It's a chilly fall day
Oh,
today.
it's very chilly.
I think woke up this morning and I think it was about 40 degrees in the suburbs, which is enough to pull a sweatshirt on. First time I think I've done it in the season, and I'm sure it won't be the last. But it's October 11th, and today we're celebrating Brigadier General Casimir Pulaski Memorial Day. So most New Yorkers probably only know Pulaski from the Pulaski Bridge, which is this bridge that arcs high over the borough of Queens. But General Pulaski was actually a Polish immigrant, Revolutionary War general, and is known as the father of the American cavalry. And he was a great aid and help to George Washington. He died of his wounds this day in 1779. A great hero of the Polish Americans, and we'll remember him for this day. And it's not just the Pulaski Bridge.
Yeah, as you mentioned, here in New York City, people know of that bridge, but they might not know what that bridge is named after or who. And I'm glad you mentioned this little history nugget here, because here in the U.S. on Monday, it'll be Columbus Day, and you and I, we will be here because the stock market will be open, but bond markets will be closed. And outside of the New York Stock Exchange, they close Broadway down, and there's a street fair, and there's also a parade in New York City.
Yes, it's Columbus Day, and the kids are off from school. There's been a big movement to make it Indigenous Peoples Day, although it's sort of there's a movement that Columbus brought a lot of evil. Well, he was an explorer, right? If he didn't come, somebody else would have come. So I think that may be a little unfair, but certainly, when there are a lot of Italian Americans, they're very, very proud, and it will be Columbus Day. Certainly, I think for the Italian American community, which is a big, vibrant community in New York City.
And looking at the stock markets on this Friday before we head into the weekend, so it's been so busy this week, hasn't it?
Absolutely.
In terms of events, economic data. We did get the release of PPI, which on an annual as well as monthly basis, it did come in slightly below expectations on the heels of consumer prices yesterday. But right now we are looking at the market higher, and we did see a mixed open today, especially as Tesla weighed on the NASDAQ, but right now we're seeing the NASDAQ in positive territory.
So PPI was interesting. The core was sort of bang on. The headline figure was a little softer, due in large part to energy. But if you look at the year-on-year figures, and generally I like month-on-month better because of my personal recency bias. It tells me what's happening recently. But the year-on-year figure on the core was 2.8. Up from I think a consensus of 2.6, and that was due to a higher revision to some of the previous months, which people haven't really looked at. And just like the other day when we saw the employment report, if you see higher revisions, that can be troubling. So and Jay Powell has said we like to look at year on year because it kind of cuts out the noise of the month-on-month. So this certainly, while the street is reading it as non-threatening, certainly bond markets liked it. The 2s, 10s spread is actually back out to 15 basis points now. It was down to 4 just earlier this week. So the markets like it. It's non-threatening, but there might be some hidden undercurrents that we won't see until we see more and more reports. But I think we're pretty much locked in at this stage at 25 basis points. Almost all the Fed speakers have said that, and with only one person, Raphael Bostic of Atlanta, who said I'd be okay with a pause, and he said that yesterday. But he stands out. So I think we're locked in for 25 basis points at the moment.
Yeah, and before we move away from the inflation data, so we got CPI yesterday, and today we got producer prices. And when it comes to the differences in terms of the readings, explain why producer prices is so important. And when we're talking about businesses or manufacturers pushing the costs of items and making consumers pay for it, how does that all work when it comes to inflation and producer prices?
So producer prices are kind of, you can think of it in a way as a trailer or a preview to CPI. That these are what the producers are paying. Sort of like think of it as an intermediate, intermediate goods, intermediate services that will eventually likely percolate its way up to the consumers, because if your costs are going up, you're probably not going to eat that. You're probably going to pass it along unless you have no pricing power. And what we've seen from inflation, CPI, certainly companies have had pricing power. They may have a little less now than they did maybe a year or two ago when we're coming out of the pandemic. There was a lot of helicopter money dropped in this country, so they could really raise prices and there's money to pay for it. But producer prices really are what is in the pipeline. So it may give us a clue to what's coming up next, and that's why this sort of jump in year on year has me. I want to watch this a little more closely. Higher revisions always make you it suggests a trend. Again, one reading. Let's not get crazy or too excited about it, but worth keeping our eyes on.
And speaking of prices, we got the preliminary reading of the University of Michigan's Consumer Sentiment Index. So that came in below 70. What do you think is going on here?
I think and this is like it's sort of consumer confidence, and longer term it's still good. But today all the stuff in the front was a little soft, and I think there's still concerns about high prices. Right, high prices is different generally than inflation. Inflation is the increase in prices, but prices are high, especially for food. Especially if you go to a fast food place, prices are much higher than they used to be, which is why McDonald's threw in a very, very popular $5 to $6 sort of special meal deal. I think they're getting a lot more traffic. We'll see the results in maybe a month's time or thereabouts when they report their fourth quarter earnings, maybe a little bit more than that. But so that, and then I think some of the storm, this election, and I hate to tie everything back to the election, but a sinking consumer confidence doesn't usually bode well for the incumbent party.
Yeah, before we move away from the consumer, so you brought up fast food restaurants, and here in the U.S., whether we're talking about McDonald's or Starbucks or other fast food outlets, they have been trying to entice the customer to come back and offer deals, right? And usually when we think about Happy Meals or other combo sets at fast food restaurants, we're thinking, oh, it's going to be quick, not so healthy, but cheap.
Right.
And if you think about how much inflation has affected these restaurants, right, here in the U.S., there are different regulations when it comes to labor laws and wage minimum. So that does affect the bottom line for these companies. But I was so surprised hearing about a McDonald's where you could get a Big Mac meal, but it was the highest in the country, over $18, right, for fries, a burger, and a drink.
Right. You can't get French fries. You go to French fries, and I have kids, and I like McDonald's, in part because I know exactly what I'm going to get. It's going to taste exactly the same. It might not be the best. It's not Shake Shack, but it's quick and it's fast, and it's still relatively cost effective. But you remember pre-pandemic there was the dollar menu. You could nip in and get 4 nuggets for $1. You can't get anywhere close to that now. Part of it is labor costs have gone up so much. But one of the things that people have always argued against, sort of higher minimum wage, is you're going to end up with potentially fewer jobs. And you walk into McDonald's now and you see automation, you see those kiosks, and those kiosks are great. There's one person maybe who's actually taking physical orders, but different languages, you punch it in, you see everything. No more waiting online 6, 7 deep, so fast. And you know what? I bet there are probably fewer jobs as this automation goes on. And you think about it, it's pretty popular.
Yeah, so no more deals like we used to have pre-pandemic when it comes to these restaurants. So whether we're talking about McDonald's, Burger King, other chains, it's quite a pricey meal.
They've had to bring it back, actually, because they were seeing foot traffic drop tremendously. So what's happening is some of their they're saying, all right, we'll take some margins on the $5 meal deal, and hopefully they'll buy something else. Or a kid comes in for a Happy Meal, where my youngest is 14 and she still sometimes likes the toy. the French fries are literally this big.
Small,
They're
right?
tiny. So, you go in and get a $5 meal deal, and your kid wants a Happy Meal. That's where they're getting the margins. But you're seeing, I think, over the years, a lot more automation in many different places.
Yeah, and a company like Starbucks, they're trying to figure out how to bring customers back into their stores as well. I was pretty shocked, so I don't regularly go to Starbucks,
Right.
but given that it's autumn, I did want to try a pumpkin spice latte. I do not consume dairy, so if you
Oh,
get the non-dairy option, it's an extra 75 cents or a
sure.
dollar depending on where you are in the
Right.
country. So by the time all is said and done, it can be $7 at tax. It can be $8 for one drink.
Right.
Right? So that's
It's
expensive.
it's a great drink, but $7 or $8 for like a fancy cup of
Way
coffee
too
is a lot.
pricey.
It's a lot.
It is, it is. Yeah, so a lot to keep our eyes
Yeah.
on, and inflation is definitely affecting consumers, but so are increases in wages as well when we're talking about the
You're
labor market.
and what we found is the people in maybe the lowest quintile, whatever you want to call it, have had their wages come up quite significantly, which is good because it's expensive to live, certainly in this part of the country, but that has had the effect of lifting a lot of prices, and I think you find that wages in the middle to slightly middle upper portions haven't really moved. And people are feeling that inflation is really slowed down, but the prices have remained high and will remain so. We don't want deflation, but high prices are here to stay.
And Tai, before we move on to other topics, since we're talking about the consumer and we're
Yeah.
talking about shopping in this country, the holiday season is fast approaching. After the election comes Thanksgiving, and
Yeah.
that's when we start seeing deals at the
That's right.
stores. And I understand that you went to Sam's Club recently.
I did. I went to
Tell us about your experience here.
my first Sam's Club experience yesterday. As a matter of fact, it was my son. He found a special on the Sam's Club membership, and you could put one additional person on. So he put me on, and I said, all right, let me go and have a look because I'm a lover of Costco. And so I went in, got my membership card. People were really helpful, and I went in, and it's like Costco, but less. It's laid out like Costco, and it's really because Sam Walton went into a Costco with Saul Price, took a lot of pictures, and Saul knew he wanted to open something like that, and Saul didn't mind, since, we know what, imitation is maybe the sincerest form of flattery, so it's very much like Costco, but it's not as well lit. One thing was the signs were not as clear. Like I look at Costco and I'm like, oh, I know what that costs, but Sam's Club, I have to sort of squint and read it a little bit.
Interesting.
But they have the $5 chicken. They have the $1.38 hot dog, which is cheaper than Costco. They have an icy, which my daughter is really excited about. They have everything is like Costco, but sometimes just not laid out as well. But the one thing that surprised me, and I used it and was great, was they have this new thing called Scan and Go, and it's not at Costco. You take your phone, you download their app, you scan everything, and then at the end you pay, and you walk right out. They'll check your cart right at the end, just like they do at Costco. But that's a lot faster. I'll tell you what, if I'm buying something really heavy, like I bought a watermelon yesterday, I don't really want to take the watermelon and like heave it over and scan it.
Yeah.
So that's another sense of like what we just talked about, automation.
Yes.
Right? There are going
Absolutely.
to be, jobs that can be done, without a person are going to be done without a person because it's faster, people are happier, and it's cheaper for the company.
And we know when it comes to automation, there are so many concerns about people being displaced by technology and automation, but at the same time, it can be convenient, whether we're trying to get through the line at a store or we're at a fast food restaurant and we want that order ASAP, or even using certain apps. So
Easy Pass, right? That cost a lot of union jobs. And the head of the ports, Daggett, was complaining about that. But you know how much faster are we driving through without having to pay the toll physically?
Yeah, personally, I've noticed when using these apps, there's less confusion if you're, say, adjusting an order or you're trying to get a specific item made a certain way, then there's less confusion sometimes when you're interacting with an app versus a human.
It is a
So
lot more efficient.
yeah, and one thing that's interesting about Sam's Club is apparently outside of Dallas, Texas, they're going to be having a scan checkout at every checkout register. So these registers will be unmanned. So just based on your experience, do you think that was a smooth process when you went through one of these new checkouts?
It was really, for me, it was very, very, very smooth. I mean, I had a little problem with the code on the watermelon, had to scan it a few times, but otherwise, like, no more long lines. Let's just go. So what you do is you maybe have one person on staff standing near the exit, helping people who are having trouble with the app. That's always going to happen, right?
Okay.
But instead of having, maybe 4 or 5 cashiers, you'll have 1 or 2 just kind of, making sure everything works. And again, customers are happier, it's more efficient, and your costs go down. So, once you've made that initial investment, and of course you have to keep the systems going, I mean, I think it does work out, and it's sort of the trend away from having humans do everything.
Yeah, and while we're talking about automation, I do quickly want to take a look at Tesla. So
Yes.
shares have been down this morning and initially had been weighing on the NASDAQ, dragging that index lower this morning. But of course, the robotaxi event took place yesterday. Many of us had watched it and had some mixed opinions. So what did you think of the event, Tai?
So I did watch it in its entirety, and I'll admit I haven't watched the previous ones in its entirety. I don't think he's the greatest showman. I mean, you want a showman, you probably need Donald Trump, right? But he's not the greatest showman. And what disappointed the market was the lack of specifics, which I think could be really tough to do because there's a lot of regulation. Are they going to allow Tesla to do these things? I mean, they allow Waymo, so I guess you want to go in there and attack the places where Waymo has already blazed the path, and Waymo is owned by, I believe, Alphabet. So that's where you want to start, but there are really no real specifics other than it'll be eventually less than $30,000. The idea is great that you can basically rent out your car, right? But we just don't know when it's going to come. And then what was interesting to me was they had the Robo Van, which was cool, but they had Optimus, the
Optimus.
robot, right? And he titled it We Robot, which is a tie-in to Isaac Asimov, and I'm a big Asimov fan. There's a book called I, Robot.
Yes.
So he brought out these robots, which were pretty cool, and he said eventually you're all going to have one, and it's going to be like $30,000. And you would say it would take people a while to get used to that, but I think society, if we can get used to scan and go, eventually, Optimus, take out the trash. Optimus, put my kid to sleep. There's some possibilities in there. So, the man has unbelievable vision. The question is, the market is saying today that, we need a little more detail. Can you really deliver on it? So I think Musk is the most polarizing CEO of our generation. There are people who absolutely love him. There are people who can't stand him and think he's, a liar. A lot of those people have been carried out, but his involvement in politics recently certainly, has made him polarizing. There'll be people who are happy that Tesla's down a lot. I just don't like shorting that guy. I think the stock probably has a little more room on the downside. But shorting guys with vision, I don't really. Long term, I don't really want to be in that camp.
Yeah, and speaking of vision, Tai, when you think about a company such as Tesla and the fact that this event that happened yesterday, they named it the Robotaxi event, and as you mentioned, we saw this massive production when it came to this announcement, but the critics who were not so happy with what came out of it, as you mentioned, regulation, lack of a timeline, safety, and when we think about concerns about privacy and data when you're interacting with a robot such as Optimus, it might make sense, but it does seem as though he's trying to move Tesla away from just EVs here and focus on technology as well.
Yeah, I think part of the reason is I think he likes the next big thing. I think he just wants to go to Mars. A lot of people think he just wants to go to Mars, right? But the EV market is getting a little saturated. I think the people who want it have it. The people who are not sure about it, myself, are probably not going to get it anytime soon. And you're reaching a sort of a maturation area where he wants to go after the next new thing.
Yeah, absolutely. So, other names that we
Yeah.
have been watching this morning, in addition to Tesla, include banks, right?
Yes.
Banks earnings season has kicked off. We saw early signs. This morning, JP Morgan and Wells Fargo reporting
Yeah.
profit declines from a year
Hmm.
earlier, but less than analysts had feared.
Right.
And we saw even in the pre-market that shares of both companies were higher, but given that we're in this trajectory for the Federal Reserve, the central bank here in the U.S., to continue gradually easing rates, what do you make of what we saw, and what can we expect as we head into the rest of earnings season here?
So both the last time I looked just before we went on air, I think J.P. Morgan was up sort of 4%. Wells might have been up the same, the same or a little bit more. One of a big surprise for J.P. Morgan was the net interest income was up for the quarter. And for all of 2024, they're now looking at $92.5 billion versus $91 billion expected. And remember about a month ago when the president, Daniel Pinto of JP Morgan, said, your NII figures for 2025 are totally out of whack. It's unrealistic. And the stock dropped by like 4%. But so this was kind of a really pleasant surprise. So maybe rate cuts, and we just got it, so we won't really see the impact until the next quarter's earnings.
Yeah.
But maybe the banks will do just fine, as the Fed cuts rates, and the gap between their deposits and where they actually lend money, at least the big banks can figure out how to keep that gap, the net interest income, which is at the end of the day what the banks, it's a big piece of their bread and butter, the blocking and tackling. That's where you get a lot of your money, because your investment banking revenue, your trading revenue, your underwriting revenue, that can always change. But that sort of buffer is where your banks make their money, and they've both done well. Now we've got some other banks coming out, the Morgan Stanleys of the world, Goldman Sachs, and they don't have a lot of NII, if any. So that is really a sense of how the financials are doing overall, and we'll get that next week. But this is certainly, the banks are up well on this, and I think it'll probably carry us to another nice day in terms of where the market is. Where is the market now?
Yeah, let's do a quick market check here. So as Ty mentioned, we are seeing JP Morgan higher, and that's why we're seeing extensive gains for the Dow Jones Industrial Average. JP Morgan shares are up by 5% in this morning hour. We're seeing the Dow Jones Industrial Average up by triple digits. So here we are at the 11:30 mark, nearly at the 11:30 mark. We're seeing the majors all higher by triple digits for the Dow. And as for the NASDAQ, we're seeing it higher by 0.2%.
Yeah.
Earlier we saw it in negative territory, but it is managing to hold above the flat line right now. And the S&P 500 is up by 0.5% right now, or over 30 points, and we're right around the 5810 level.
Yeah, I think I think the markets are going to have a good day. Tesla's a little bit of a drag on on the Nasdaq and certain small sectors, but I think the mood is today in the market seems to be relatively positive. And we're running short on time, but a couple of things I just wanted to touch on. Gold has had a tremendous rally over the last couple of days. Looks like it might actually end the week flat or slightly up. Which is just it's a bull market, and it was 2604 the low the other day. I think it's over 2650 now. I don't like to mess with a bull market. It always makes and I think I'm not really big enough. The last thing I do want to touch on was I was surprised to see late afternoon, early evening yesterday, crude had jumped sharply, and I went immediately to all my news to see if there had been an attack. There hasn't yet been. And what's interesting is the Iranians had made a really, I think, smart announcement. They told all the Gulf Arab states, who are not their friends, remember, they're Shiite and the Gulf Arabs are all Sunni, that if you let Israel use your airspace to attack us, we cannot guarantee your safety. That's pretty smart. That's saying, listen, don't make it harder for them. We don't want you to like help them attack us. And you wonder almost if the Israelis have waited so long because they've gotten a lot of pressure from the Biden administration to say we don't want to hit on the nuclear facilities, we don't want to hit on the oil, we just don't want anything to happen in the next 3 weeks into the election, which is why they've waited so long. But you get a sense that it is probably coming.
And Tai, that is one area we will definitely be keeping our eyes on, and that is politics as well as geopolitics, especially as we edge closer to November 5th, the presidential election. Hard to believe that we are fast approaching that date, but Tai, as always, thank you so much for joining me here, and have a great weekend.
Great to be here. Same to you.
Thank you so much, Tai. And coming up next, I will be joined by Dan Ha, partner at Karani Asset Management. Don't go away. We'll be right back. Welcome back to Global Money Talk live from the New York Stock Exchange. Earnings season is underway and the latest readings on the U.S. labor market as well as inflation figures have been released. With U.S. stock markets trading on both sides of flat this week, but record highs notched by some of the major averages, there's no better time than the present to take a look at the bigger picture. I'm joined by Dan Ha, partner at Karani Asset Management. Dan, happy Friday. Thank you so much for joining me.
Thank you. Happy Friday. Happy to be here.
Well, it has been quite a week in terms of economic data as well as other events. So tell me your perspective, given that the S&P 500 has made a new high this week. What are your thoughts?
Sure. Well, we're cautious. Now that said, cautious doesn't mean that we think things are dangerous per se. Our valuation work, we do valuation work from the bottom up. We're stock pickers. Our valuation work suggests that things aren't cheap, clearly, but it also doesn't suggest that things are overly expensive. So things are about sort of fairishly priced, but from a risk-reward standpoint, those aren't the most attractive facts when things are just kind of priced about right. But again, it's important to stress that it also doesn't mean that things are really dangerous and you should run for the hills. What that means for us, for instance, is that we have a flatter portfolio now, and what we mean by that is we're not making outsized bets within the portfolio, among the individual positions that we own. We're not making huge outsized bet. Now, we never own everything at complete equal weights.
Okay.
We will have our favorites in the portfolio where we will own more of one stock than another. But the difference, if you will, the concentration in the individual positions is not as big as what we had, say, last year. Early last year, we were seeing much stronger valuation opportunities, much more attractive risk rewards. And in those circumstances, we will make larger bets on our favorite stocks, depending on the valuation. However, right now, our positioning is a lot flatter, and that reflects the lack of really attractive, high conviction valuation opportunities in the market. Now, having said that, because we're cautious, does that mean we are not fully invested? That's actually quite the opposite. We're rather fully invested, and we've been throughout the entire year, even though we have had this cautious view for the entire year, which may sound contradictory, like how could you be cautious but also fully invested? Well, for an equity investor, or for any investor for that matter, we think you can control risk really through one of two ways, one of two levers, if you will. You first have to decide how much do you want to be exposed to the market. So that should govern what % of your portfolio do you want to risk? Do you want to invest in the markets? But then also you have to figure out what are you going to own within that exposure. And so for us, we've been cautious, but we also have the view that this could be year two and heading into year 3 of a bull market, which is why we didn't want to sit out. We didn't want to sit on the sidelines. We wanted to participate, so we were rather fully invested, but we were doing it through what we thought were less risky names. So we were mostly concentrated in blue chip type names, and that was a portfolio that we sort of came to peace with, if you will. I had an opportunity to interview Howard Marks, which was published over the weekend, which I think everyone should check out. He stressed the importance of being at peace with yourself as an investor, which I'd be happy to go into. But when you're cautious in an up market like this, you'll have to. It's quite possible that you will underperform in a strong up market, and we knew that coming into this market. But because of the risks that we were seeing also of slowing economy and the potential for the economy to tip into a recession, which I talked about when I came on the show earlier, we didn't feel that it was necessary or that we were being paid enough to make outsized bets and really stick our necks out, which is why we maintained this balance, and fully understanding that if we were to have a strong up market, that we could and probably would trail the market by a few percentage points, and that's okay. That's what we decided was the right thing to do for the year, and that's how we've been positioned all throughout the year. Certainly benefited from the rally, perhaps not as fully, but that continues to remain our position.
And Dan, I do want to ask you a little bit more about the Howard Marks interview, but before we get to that, as you mentioned, you gave us an overview of your philosophy and the work that you have been doing. And indeed, when we're standing here at the beginning of the fourth quarter and we're seeing double-digit percentage gains for the major equity averages year to date, the Dow, Nasdaq, and S&P 500, I think it is very important to have perspective. And you mentioned the importance of maintaining balance, so can you elaborate on that for us?
Yeah. I mean, so right now things are good, right? Market's up. economy seems to be doing fine. Labor market seems to be while slowing, still healthy. Things look great, which is why stocks are up probably. However, balance is always important. There are times when there are times when valuation would warrant you to be more aggressive, and go after very attractive opportunities. And also there are times when in the cycle where you should be extra cautious and maybe pare back some risk, pare back more aggressively. However, balance is important at any point in the cycle because you can't predict the future. So right now, things look good, but for instance, earlier this week we had Danielle DiMartino Booth, who shared a very, what I found to be helpful insight about hours before bodies, she said, right? Hours worked is often a precursor to what might happen to bodies or headcount. And hours worked are rather sort of weaker, which means that people are working less hours. And if this continues on, then it could lead to headcount reduction, which will have then ripple effects to the rest of the economy. Depending on who you ask, you're going to get a different answer as to where the economy is and where it's headed. People have different opinions about whether the Fed was too soon to cut, or too late to cut, or was just the perfect time to cut. It's impossible to know. And the economy is like a huge oil tanker. It doesn't respond right away to the moves of the Fed. As we have seen, the economy takes time to respond to interest rate increases. It also takes time to respond to interest rate cuts, right? So, the trend is important. Economic trends usually don't just turn around overnight just because the Fed did something this week. And therefore, I still think there's plenty of risk with the economy slowing, the labor market slowing, that there's still plenty of risk that the economy the big oil tanker would continue to drift downward, if you will, before it turns around and starts to grow again. And in that kind of a scenario, you probably want to be defensive. And so, sticking your neck out, there's a time and a place for that, I think, as an investor. And you have to understand what the downside risks are, while also appreciating the upside risk. The analogy that I recently used with a friend of mine is, think about driving a car on the highway. You want to cruise at a pretty high speed, but you probably don't want to be the fastest car on the road. There's a time and a place for that. There might be situations where you'd be okay taking on that risk, but if you're on the highway and if you're the fastest car on the road, there's no one else in front of you, and you're just got pedal to the metal and going really fast. You will probably get stopped at some point. You might get lucky and not, but in certain parts of the cycle, you probably don't want to be the fastest car. There will be times where you should be okay that you're not the fastest car on the road, that but you're still cruising at pretty fast speed to participate. But be cautious and be careful. So I think maintaining that balance is hugely important for an investor.
And I think those are very befitting analogies you have both with the oil tanker as well as driving on the highway. And I do want to move on and ask you about the Howard Marks interview.
Sure.
So for our viewers, I'm guessing most know Howard Marks, and many of you may have already seen this interview, but give us an idea of the topics you covered, what surprised you, and any key takeaways for you from this interview.
Right. So that interview was such a treat. I've read his books, his memos, watched his interviews, basically growing up professionally. So that was very special. And Howard Marks is somebody who will also probably tell you that balance is really important, and it's important to think about the future in terms of odds rather than trying to be right. Having said that, the one question that I really wanted to ask him was about the difficulty of holding on to long-term winners in stock investing. Um, that's something that I've wrestled with, throughout my career as an equity investor, and it's something that I continue to wrestle with because in equities, compounding is so powerful that when you find a company that is compounding capital really well, you probably don't want to get in the way of compounding, basically, building your wealth. At the same time, it's a risky thing to, as the winner continues to become a larger and larger portion of your portfolio, to not do anything about that is risky. So the prudent thing for investors to do is to rebalance their portfolio so that not one position becomes so large in your portfolio that if that position crashes, that it damages your portfolio too much. At the same time, you want to strike the right balance and actually hold on to these long-term winners if you have found one. And again, like I said, not get in the way of compounding doing its work. He and I probably agree that and this, by the way, everyone needs to find what puts them at peace, and it also depends on the strategy you're pursuing. Howard Marks, through Oaktree Capital Management, is mostly a credit investor. It's a bond investor. And in bond investing, your upside is generally capped. If you buy something at a discount, if you buy a bond at a discount, and you hold to maturity, you'll get all your money, you'll get your principal and all the interest, but your upside is contractually limited. So it makes sense for him to focus more on what could go wrong because his upside is capped. Also, if you are a venture investor, for instance, you're making hundreds of bets on small amounts of hundreds of bets, and some of them are going to go up 100 times, 500 times, or even 1,000 times for you. And in that case, you do want to, because you're counting on those rare winners to really make the overall return for the portfolio, you probably don't want to be trimming your position, because if you do, then the very strategy that you're pursuing is probably not going to work. Public market investing, while it's possible to find companies that may go up 100, 500, 1,000 times, it's very rare that you find those types of companies. Therefore, I think at Karani Asset Management, we manage public market portfolios with the mindset of trying to play singles and doubles, because we believe that if you're really good at playing singles and doubles, every now and then you're going to hit a home run or two or three while you play for singles and doubles, using a baseball analogy. If you run your strategy, and the strategy that you run depends on hitting many home runs, statistically that's just very difficult to do. And also in public markets, there's a lot of volatility. So when your winner, compounder, becomes, you buy 10 stocks in a portfolio, let's say at 10% each, and your winner just went up 5 times, and all else were kind of flat, it just became 50% of your portfolio. Next year, if that 50% position goes down, draws down 50%, then the damage is going to be very big to your portfolio. And there's a question of, can you actually withstand that as an investor? So, we try to aim for singles and doubles, and certainly hope that while we do that, we'll hit a couple of, a home run or two or three to really drive the overall return of the portfolio. So that was a very helpful insight. And I would just kind of add to this whole idea of being at peace with yourself as an investor. I think every investor needs to find a strategy that works for them. Some people are more aggressive. Some people can handle volatility way better than others. And if you're a type of person that can't handle volatility, or if the money that you have risked is the kind of money that you can't handle that can't handle volatility. For instance, you have some excess savings. You might need that money next year, and you invest that money very aggressively in the stock market where anything goes. I mean, anything's fair game. A drawdown of 50% is possible. You probably are not going to be able to make good rational decisions when that money that you need next year just went down, drew down 50%. So finding the right strategy is extremely important for every investor. And I suggest that every serious investor study the different kinds of investment strategies out there and find the gurus, if you will, in those fields, and listen to them, study them, hear what they have to say, and think about how to implement it in your portfolio, which is, I guess, what I'm trying to help with a little bit today.
And Dan, I think those are some very sage observations there based on your personal as well as professional experience. But before we move away from Howard Marks, apparently he said that rules are meant to be broken,
right.
But it does sound like you were suggesting that some rules are necessary here. So can you explain this for us?
Sure. Yeah. No, that was a fun conversation. I asked Howard Marks about rules because in one of the more recent letters that he wrote, or memos that he wrote, he talked about how there are really no rules in the investment world that could be depended on all the time to produce good results. And so, I asked him, however, sometimes it's good to have rules, even though rules aren't perfect. And, he was joking, but also serious about how rules are meant to be broken. But what I was trying to get at was, I do think rules are necessary for most investors. If you're Howard Marks, if you've been around for as long, if you've seen as much as he has, if you have experienced as many cycles as he has, then perhaps you can operate without having strict rules, because you could really rely on your judgment being highly accurate. For me, I need rules. Because for me, the alternative is trusting myself, which, I'm not so sure if I would fully trust myself always. A lot of the very accomplished psychologists will agree that human brains are prone to biases and irrationality, no matter how hard we try. And that's why we actually at Karani, we read psychology books as a team together regularly to remind ourselves of that. And we've come up with rules that are really meant to keep us out of trouble. And rules, while they're not perfect, when you have strict rules, sometimes that'll get in the way of you finding the next, great winner. So you'll miss things because you are adhering to the rules. Rules yield false positives. Those are part of having a rule. However, for the most part, and more often than not, rules keep us disciplined, help us stay rational, and really help us stay out of trouble. So I think rules are important. Investors could look back into their own experiences to think about, okay, if I were faced with that situation again, what would I do differently? Had I known what I know now, what would I have done differently? That's a very healthy and helpful exercise to try to think about, okay, these are some of the rules that I'm going to stick to, and hopefully it'll make one a better investor. Now, you also have to be flexible enough to modify those rules, not break the rules necessarily because you're adhering to your own rules and you're seeing your neighbor get rich and you can't stand it anymore, so you're like, well, I'm going to modify my rule now. That's probably the wrong reason to modify them. But as you accumulate experience as an investor and see more things and experience more things, you should absolutely be modifying your rules so that the rules are better. But I think for us, mere mortals, I think rules are probably more helpful than not. And hopefully I can get to someday to a place where I won't need rules because I have so much experience around my, so much experience and wisdom around my belt. But that's a long way.
Well, it's interesting, Dan, what you mentioned about studying psychology and reading some of these books. Perhaps a segment later on we can focus on some of these authors that you've mentioned when it comes to psychology.
Yeah.
And when you mentioned, this thought of envy or comparison to your neighbor who might be doing better in terms of their personal portfolio.
Right.
There's a reason why they say that the comparison is the thief of joy.
Right.
For that very reason. So I think psychology does play a very important part when it comes to investing.
Right.
But I do want to ask you one more question regarding Howard Marks.
Sure.
So apparently you asked him a question that he said he's never been asked before.
Right.
And this was in terms of odds, so investing and odds. So how can viewers out there who are watching right now apply what you talked about with him and what you asked to their investing?
Sure. No, happy to recap that part of the conversation so that I could get people interested in watching the whole thing. All the viewers should definitely go and watch hear it from him. But the question was, Howard Marks famously thinks about investing in terms of odds. And in my experience, and I certainly had the phase too, where I think most people, at least the ones that I've encountered, think about investing in terms of being right. So they think investment success is being right or wrong, and therefore you're trying to think about a future where you can be right and bet on that. Howard Marks thinks about the future in terms of odds. So, where could I be investing right now where I have a higher chance of winning, and therefore or high payout if I'm right, and a low loss if I'm wrong. And yes, he did say that was. He said I don't think I've ever gotten that question before. But I think the important takeaway from his answer to that question is the fact that he attributed the way he thought about that to maturity, of him maturing over time, and how he therefore started to think more and more probabilistically in terms of odds rather than being right. Right. I mean, the future is the future. It's impossible to predict anything about anything that has to do with the future. Nothing's certain, right? And so you have to be able to think in terms of, okay, if I'm right, how much am I going to make? But if I'm wrong, how much am I going to lose? In that context, I think it's critically important for investors to structure their investments in a way that you could withstand the inevitable drawdowns or the inevitable bad things happening to your portfolio. So for example, you buy 10 stocks in a portfolio, and because you like one so much more than the other 9, you make that one position 80% of your portfolio. I'm using extreme examples, and the other 9 make up 20% of your portfolio. Well, bad things could happen randomly. And so, we actually get a lot of inspiration in terms of risk management from the insurance industry. And, my partner Richard was on the show the other day talking about insurance and good insurers. And as an insurance analyst decades ago, to be fair, but he followed a lot of these really good insurers. And the best ones really understand that the future is uncertain, and they really appreciate that bad luck could strike anybody. And so if you have a portfolio of 10 stocks, but your risk is really concentrated in just 1 or 2 or few positions, bad luck could strike. When bad luck strikes, it doesn't really discriminate, right? So if it strikes the one position that is 80% of your portfolio, and if that goes down 50%, then the damage to your portfolio is going to be very large. So you do want to structure the portfolio so that when the inevitable bad thing happens, because when you think about the future probabilistically, you're thinking that, okay, good things could happen, but so could bad things. And when the inevitable bad thing happens to any one of your positions, can you actually afford to lose? Can you actually afford to handle that drawdown? So I think thinking about it probabilistically, thinking about it in terms of odds, is extremely important. And based on what Howard Marks said, I think that really comes from experience. When you've experienced enough situations where you are so sure, you are so convinced that, oh, like this bet, I am so convinced, and it just doesn't turn out the way you expected it to turn out. And once you've had enough of those, I think you start to appreciate more how to think about, okay, I'm really convinced, but I also know that it could not work. And so how much of my capital do I want to risk in that one high conviction or two high conviction investments?
I think you've done such a great job of breaking down your conversation with Howard Marks, and for all of you, you can find it on our YouTube channel on SamPro TV. But when it comes to this approach of probability, for those of our viewers who may not be familiar with what the difference is between a probability versus some other approach, can you explain and break down what it is that you mean exactly when you're talking about the odds?
Sure. I will actually use Google, which I talked about the last time when I was on the show, to explain this in sort of real life example. So last week I was here talking about how Google, in our view, presents an attractive risk reward. I'm not saying that it'll definitely work. That's just not the way we think, but it presents an interesting risk reward. Just last week, Google price or Alphabet's stock price was under some pressure when the DOJ basically announced that they may pursue breaking up the company. Breakup of Alphabet, the DOJ being at their backs, is that a good thing or a bad thing? Well, there's some people who believe that it'll be a major distraction, just like how when the DOJ was pursuing Microsoft as a monopoly, that many will agree was a major distraction for the company, and therefore really got in the way of company innovating as much as it could have. And right now, Google and the technology world is in an important place where everyone's rushing to become the leader at AI. And so now is probably not the time you want to be distracted with regulatory issues. So that's a credible argument. At the same time, there are people who also argue that, well, if Google were broken up, the sum of the individual parts will actually be greater than Alphabet's current market cap. So it's actually going to be a good thing. Who knows? The honest answer is, I don't know. And I'm not a legal expert, and even if I were a legal expert, and telling you what I think is likely to happen, our viewers probably should only take that as, okay, it's one person's opinion. It's a very well-informed opinion, but it's still not an accurate prediction of the future. So you do have to appreciate the fact that it could work out really well, or it could work out poorly. And putting any sort of credible probability on, well, I think there's 75% chance that it'll work out well, and 25% chance that it won't work, that it'll work out poorly, I think is not so meaningful, because the future for Google is, it's either going to be good or bad. Like, 75% or 25% doesn't really mean much. So you just have to think about, all right, I'm going to make an investment, I'm going to make a bet on Google. If it works out well, I'm probably going to make some good return, because I think if these problems go away, I think Google should be valued much more highly than now. But if it doesn't work out well, you will lose money. So you have to think about, okay, how much can I afford to lose? Because a loss scenario is probably just as likely as a gain scenario. And so, you have to manage the risk by managing the exposure, and how much money, if things don't work out well, can you afford to lose? Because in the future, anything is possible.
Okay, Dan, well, I think that was a very helpful example, so thank you so much for joining me on this Friday and for giving us an overview of a lot of the great content that came out from Sempro TV this week. Thank you.
You're very welcome. Happy to be here.
And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sempro TV. You can check out the show as well as Dan's interview with Howard Marks anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll see you back here bright and early on Monday. Have a great weekend.